We learnt a lot in the global financial crisis, certainly from an Australian perspective. We had a well-regulated banking system. There were some measures that had to be introduced that we learnt from. Comparatively, the regulation, particularly in the UK and the US then, was light touch. That wasn't the case in Australia. We built on our regulation in Australia, and certainly the global regulators have built on and added to their bank supervision in every country. One of the interesting characteristics and developments out of the global financial crisis, there's a much greater level of understanding of the risk to banks. There's a great deal of cooperation, understanding globally as well as at the national level.
We saw some of that cooperation overnight. You were Financial Services Minister during the GFC, where we know banks were teetering, short sellers were sending share prices plummeting, liquidity was drying up overnight. We know that the government announced a raft of financial stability measures, including stimulus packages and, of course, the deposit guarantees. What was being assessed back then? How were these rescue packages being arrived at?
Well, firstly, the banks were secure. The banks themselves were liquid. The central challenge, and this is another fundamental difference, is the share market collapsed. It went from 6,900 to 3,200, and financial institutions, because of the nature of a banking crisis globally, their share price tanked. And so you had short selling where speculators in a high-risk, uninformed market that was totally irrational and fear dominated. So short selling became a problem. So in order to secure banks from being adversely impacted, one, of course, deposit legislation. Two, we banned short selling. And that ban remained in place for all of our businesses in Australia, but remained in place longer for banks, and that underpinned their security.
So what should governments and central banks be assessing now with this crisis? What was learnt back then that could perhaps be applied now?
Well, certainly APRA, I mean, it's a very strong regulator, and I'm confident they were strong in the global financial crisis. They're even stronger in their regulation of our banks now, and that's pretty much true globally. Unfortunately, in the US, there are thousands of banks, and some of the smaller, medium-sized banks have not been as effectively regulated perhaps as they should have been, and Credit Suisse had its own particular challenges for some years. So there were particular specific circumstances. But look, APRA has remained vigilant. I'm chair of a super fund. They're very vigilant in their prudential engagement and management of both banks and superannuation funds. We're at a higher level of regulation than we were in the global financial crisis, and I'm very confident that our financial institutions in Australia are robustly regulated and are safe.
Nick Sherry, it's been great speaking with you. Thank you for your time.
Thank you.
Well, bonds have been thrust into the spotlight since the recent spate of global banking failures and near collapses. The Credit Suisse UBS mega deal wiped out $17 billion in T1 bonds. The demise of SVB was largely due to its exposure to long-dated US Treasuries, which it was forced to sell at a $1.3 billion loss. And this all comes at a time of rising rates after decades of cheap credit. Schroders McCase says distortions in the bond market are putting central banks between a rock and a hard place.
What we're seeing in the bond market at the moment is high levels of volatility, and we think this is part of this transition as we move from very loose monetary policy settings to very tight conditions. And what the Fed's effectively trying to do is basically get inflation under control by aggressively hiking interest rates, and that has obviously had an impact on the capital value of bonds. What we're seeing now is heightened volatility ongoing, as the market really tries to second guess where central banks are going to basically tap out and no longer hike rates. But we still see there's an inflation challenge, despite the fact we have a somewhat of a banking crisis that some people are naming it. And I think we're going to see ongoing volatility as we move through this adjustment phase.
So what are the implications of this distortion?
Well, I think what we've seen quite clearly in sovereign bond markets globally is a large readjustment in terms of the capital values. As interest rates go up, bond prices go down essentially, and that has led to pain across multiple sectors in the economy. So whether you're holding a sovereign bond as a bank or you're holding as an investor, the capital value has dropped to reflect those higher interest rates, and as a result, a lot of investors and holders of these bonds have had deeply negative returns over the recent time. So what we're seeing is we're moving through this painful transition phase. But the positive is that valuations have improved. What we need to focus on now is the endpoint in terms of central banks. And I think that's what we're really seeing at the moment, is that markets are second guessing when the Fed's effectively going to stop out, bearing in mind it still has an inflation problem, but also too the banking system starting to actually show some signs of quite acute stress.
How long will this painful phase last?
Well, I think two things are happening at the moment. Currently, we've seen the ructions in terms of the banking system. We've seen Credit Suisse get bailed out. And I think if they can contain the banking system, which it looks as if through flooding liquidity, opening discount windows and actually stabilising the system, then I think they can go back to focusing on fighting inflation, which is really what they're needing to focus on at the moment. So I'd expect continued volatility through markets as we move through this phase. I'd expect that the banking system will continue to be a key focus globally. But I think ultimately the Fed has to get inflation under control. Otherwise, we know there's got more challenges coming down the pipe.
Mick, you mentioned the added complication with central banks trying to tackle inflation while trying to save the banking system. Which do you think they'll prioritise, and what will the ramifications be?
Well, what I think we've seen effectively is that the central banks have hiked rates aggressively to try and combat inflation. And what we've seen here is basically something's broken. Stress in the banking system has emerged quite clearly. And I think what they're doing is they're looking to mop that up so they can still deal with the inflation challenge. Now, it may mean that they step back at some point in time in order for the banking system to stabilise, but I think ultimately they have to get inflation under control.
And what about other bonds, Mick, like convertible bank bonds? We saw $17 billion worth of Tier 1 bonds wiped out in the Credit Suisse deal. Shareholders prioritised over bondholders, but European regulators overnight have said owners of this debt would only suffer losses after shareholders have been wiped out. So how is this going to impact on the pricing of these types of bonds now?
Yeah, well, I think it's actually thrown a bit of a cat amongst the pigeons in some of these markets. And I think if you cast your mind back to sort of post the GFC and Basel III, part of the design of these capital instruments, hybrid capital or tier capital, was effectively to be loss absorbing in a situation when a bank became non-viable. So the regulators arguably have sort of forewarned investors in this segment. But I would say from what we're seeing at the moment is that particular situation with Credit Suisse, there were some quirks in it. First of all, under the Swiss laws, the way it was actually wiped out before the equity holders took the pain was a little bit unusual. But I think it just bears in mind the fact that by different jurisdictions and even different individual securities, the terms and conditions vary, and it's actually like buyer beware in a lot of these situations. So whilst it may have been unexpected, it was still permissible under those particular rules.
So can bonds still be considered a safe bet? Can they be used as a diversified risk asset?
Well, I think in terms of sovereign bonds, the benefit of the pain, if you like, of the adjustment phase is that we're seeing sovereign bonds be closer to fair value now. And that means from a portfolio construction perspective, they've gone from being, having the inability to diversify, say, equity risk, now to being more fair value and basically reasserting themselves as part of a broader diversified portfolio. So in the case of sovereign bonds, particularly the major economies, then we expect that the importance of duration-based assets is going to reassert itself as we move through this next phase. I think the corporate bond market you have to be cautious of. Clearly there's credit risk in there, so I think that's going to be much more careful in terms of how we watch those individual issuers as we move through this phase of tightening lending conditions and higher interest rate settings.
Mick Case, thank you.
Thank you very much.